So I'm pretty excited. In about 9 days, Bowen is going to go to school. He'll be a kindergartner in the school that Burgess, my wife, started for him and 129 other students in Redwood City, Connect Community Charter School. Just an amazing story. My wife founded it 2.5 years ago. I was the angel investor in it. We um, made sure that it got funded and got off on its feet. And now external funding is happening, and there's going to be 130 students that are going to be able to have world-class, cutting-edge, emotional-based, project-based learning, basically learning how the brain really wants to learn, unlike a lot of schools where they just teach memorization. So I'm really proud and excited that after a big haul of 2.5 years and putting this charter school together, that it is starting on the 26th. So very excited about that. My market situation report for this week is about things that are changing, but that no one is seeing, or maybe that very few people are seeing. And it's hard to see what's obvious. It's hard to see what's in front of you. And the reason I talked about the charter school, I'm very excited and proud what Burgess has done and what's been created, but it almost also kind of shocked me that no one had wanted to start a charter school before Burgess did. I mean, the schools had been failing in our town for so long, and I guess maybe it was just easier to send your kids to private school or ignore it or hope it got better. But there's some changes that are happening in the investment world that I want to talk with you about, and these are my thoughts of the week. And I'm just curious how many people are really noticing these changes. And so my thought is, how long will it take the public to notice these four tectonic changes in the investment world? There are four major shifts that are happening in the investment world that people are either not aware of or not aware of enough, and by the time they do become aware of it, they probably will have lost 10 years of investment life, if not more. So let's jump in and look at these four. Now, the first one, which is shown through this very magical picture of the Earth, is that there are more people living inside that circle than outside of it. The GDP center of the world, the direction that the world is going to be moving, this planet, is going to be happening more and more from inside that circle than outside of it. And we, as people, most of us, need to know what's going on inside of there, because that's going to dictate future changes for the investment world, the economy. I'm talking about the world economy. And if you see yourself living somewhere outside of that circle, then you need to make note that what's happening inside of there is changing the direction of this world. How they buy investments, how they sell investments, how they live, how they want to live, what they want to eat, that is changing your day-to-day, your year-to-year experience. And having spent a considerable amount of time of my 20s living in China and India and Singapore and Hong Kong and Australia, though Australia is not inside that circle, that's given me great insight to kind of understand what's happening. But that is a major shift that's happening in the world, and most people in the West or outside of the circle do not really see it happening. Now, how does that impact you, this shift? Well, what's happening is when those people, stop buying our investments, that makes a dramatic change and shift inside the United States and the West. So the screen you see here is the net purchases of all long-term U.S. assets. And if you look over to the lower right, you can see that in June, the net purchases was a negative number. So a negative amount of assets were purchased, or about $80 billion worth of long-term treasuries, agency treasuries, corporate bonds, corporate stocks, and even net domestic purchases by foreigners. So this is both government and individuals selling. But $80 billion was sold of U.S. assets. And if you look on the screen here, you can see, even going back to 2008, which was the last big dip in this, that was when Lehman collapsed and Bear Stearns collapsed, and the selling of these assets is even greater. Well, that direction started really back in 2010, so we're a full 3 years into that. That is a shift in direction. Foreigners not wanting to buy our debt anymore. Why do they not want to buy our debt anymore? Because they see how much money printing the U.S. is printing. This is making a huge shift in the world. Because what happens is, if they don't buy our debt, and they were huge buyers of our debt, not just people in the circle, but foreigners. That means the yield is going to start going up on our treasuries. Now, if you look at the screen here, when that line goes higher on the screen, that means the yield, specifically on the 10-year treasury, is going up, which means the price is going down. Now, why this is a tectonic change is because if you look down here in June of 2012, that's the low. That's the low that will hold for probably another 60 years. And that means yields are going to be going up over the next 30 years. And this is going to really impact people who are over the age of 60 because most of them are in yield-sensitive investments like bonds. But there's some major resistance points that have been broken. The first was that 2.4%, which is the red line. It clearly broke above that and took off. The next point was this downward trend from 2007 that is just literally getting broken right now. So this direction, though I'm not saying it's going to continue going straight up, is clearly broken out from its 30-plus year bull market in price, bear market in yield. And that has changed. That's a tectonic change in the investment world. And then the next major resistance it's heading to is about 3.75%, plus or minus. So what happens? Now there'll be some correction and some sidewaysness before then, but if this 10-year yield breaks above 3.75%, that could actually put a lot of downward pressure on the economy and on housing. Right now, not so much, but the big tectonic shift that's happening is this 30-year bull market in lower and lower yields over decades has changed. It stopped 13 months ago, and it's moving in the other direction. The other tectonic plate change is what happens when the U.S. government stops printing money. Now, one day they will stop printing money. It's not if they will. They absolutely will stop printing money one day. And if you look at this price chart here, you can see that vertical dashed line kind of pre-money printing and post-money printing. So before money printing, the correlation with the Fed printing money and the stock market was zero. There was no correlation. But since the end of 2008, about November of 2008, money printing and the stock market going up, there's about a 90% correlation. Now, everybody knows who spends more than about 5 minutes researching the history of currencies in countries knows that any country that prints currency eventually implodes and collapses. Now, I'm not saying the U.S. is going to collapse and implode because I'm hoping they will stop before we get there. But the reason why countries print money is because it feels so good at the beginning, because it works at the beginning, and it's working right now. It's been working the last 5 years. That's why more and more money is being printed. But that is going to slow down. I think that's going to slow down in the next 6 to 9 weeks, especially with the next FOMC meeting coming out in September, and that will be the last one that Bernanke is the Fed chair for. So this is a tectonic shift that's coming. I think the Fed sees the bubbles that are getting created from this money printing. Unemployment is good enough. GDP is good enough. The Bureau of Labor Statistics is going to change the way GDP is measured anyway. It's going to be some more manufactured numbers. But this is a tectonic shift that people have forgotten about, that money printing is not going to go on forever. And for those who believe that we're back into a buy and hold or buy and forget or passive income, I think there's going to be another, 30 or 40% correction in the next few years that's going to upset that belief that you can just buy and hold. Then the last one of the 4 tectonic shifts is precious metals. So the first one had to do with foreigners, where the center of the power is on this planet, how foreigners are going to affect how investments are made in the West. That's a huge shift. The second one is interest rates, where those are going over the next 30 years. The third one is the stock market and how the stock market is at new lifetime highs on the back of a 90% correlation with trillions of dollars being printed. And the fourth one is precious metal mining stocks or precious metals. And the reason I have precious metal mining stock on here, this is a price chart of GDX, is because I think most people, maybe not those listening to me, believe that gold is something that was in a bubble from 2000 to the end of 2011, and then it popped, and then it's over now. And that's very far from the truth. What I'm showing you here on the screen is the precious metal mining ETF GDX, and it fell 67% from September 2011 until June of 2013, about 7 weeks ago. And the low was put in. The low was put in for precious metal mining stocks on June 26th, and most likely the low was put in for gold and silver. There could still be some correction below this line. If you look on the screen, you can see that there is some, I don't know if I'd call it major resistance, but once precious metal mining breaks this resistance and sits on that red line, the correction will have finished, and the move up to $60, $70 for GDX up into and then past that to a doubling will be full in force, and it'll take the next 3 to 5 years to do that. But the correction is over, and the final nail in the correction being over will be this price chart breaking above the red line, sitting on it, and moving to the upside. And you did hear me correctly saying that we will go back to new lifetime highs, back what we had in September of 2011. And then from there, we'll at least double from then, which on GDX has us at about 130. And today we're at about a 30. So that's about a 400% gain from here. So even if you miss the move from about $23 to $30, which is about a 30-ish% move, there's still a gigantic move in front of us. And that's a shift that most people aren't noticing, because if you go back and think who lives inside that circle, Indians live inside that circle, Chinese live inside that circle, Vietnamese, Thai, Malay, people live in there who have grown up through a period where they know paper currencies don't work. They love gold. Gold is part of their culture. It's in their DNA. Gold is going higher. It will break 2,000. It will break 3,000. The money to be made in the next 3 to 5 years is in precious metal mining stocks. And that leaves me to my talk that I'm going to be doing on Wednesday called Accelerate Your Portfolio. And basically, I have just 2 questions for you here. Is your investment approach based on buying strategies or stocks? And what my entire adult life, which has been spent on cracking the code on what really works in investing, tells me is people who grow their money well, they buy strategies. They invest in strategies and not stocks. Stocks come and go, but strategies are based on principles. Let the strategies do the hard work for you. And then the second question is, and how can being diversified into strategies and not sectors or stocks better protect your money? Most people think about diversification as being diversified into stocks or ticker symbols or sectors, but really what you want is to be diversified into strategies and let those strategies diversify and manage and protect your money over time. You guys have a great weekend. I'm looking forward to, this is what I think our second to last weekend before school starts, so we're starting to get a lot of things around before Bowen goes to Connect. I thank you for being in my world, and I look forward to speaking with you soon. You guys take care.